So welcome to this REGMIFA webinar. I'm very honored to welcome all of you. My name is Laure Wessemius-Chibrac. I'm the chair of the board of REGMIFA, and we will be now starting this webinar on investing in Africa through a blended finance fund. So maybe, Debo, if you can move to the next slide. Yes, so that's the title. Specifically, we hope to be able to bring some insights for part of the audience that are institutional investors. Maybe let's move on to the next slide to show you the program of the day. So I'm very honored to have some distinguished speakers today with us. So let me introduce them for you. Chris Clubb, Managing Director at Convergence Blended Finance. You joined Convergence in 2016, and before that you were Director at EBRD, Director of Export Canada, and a Senior Banker at TD Bank Group in Canada. Welcome, Chris. Then we have Edwin Slingerland, Investment Officer in the Asia Financial Institutions Unit at FMO. You joined FMO in 2021, and before that you were a Relationship Manager at Rabobank in Utrecht in the Netherlands. And finally, we have Leyva, who is Head of Blended Finance, at Symbiotics Asset Management, and of course, Fund Manager of REGMIFA. Luz, you joined Symbiotics in 2021, and before that you were Director of Hedging Services at MFX Solutions and a consultant for IFC and the ILO. So looking forward to having the presentations today. Blended finance is an important topic. We talk more and more about capital mobilization, especially for emerging markets. And actually, Africa has a tremendous potential, but it's very often considered to be a higher risk jurisdiction. And blended finance has been already since many years one of the go-to solutions to be able to invest in the region. So today what we would like to do is give you an overview of why some of the investors are investing via a blended finance vehicle. So we will be taking some questions. We've left ample room for Q&A after the presentations. A small practical detail, if you have questions to ask, so don't forget to use the Q&A. If you don't see immediately your question popping up in the Q&A, don't worry. It's because we will be reviewing them and seeing in which order we will ask them, but they will be reviewed by the team. And then, so I'm basically going to give the first word to Chris to start talking about, maybe Debo, you can show the next slide, talking about how Convergence is actually supporting blended finance in the context of Africa. So Chris, the floor is yours.
Thank you very much, Laure. Hi, everyone. By the way, I'm just recovering from COVID. So my voice is a little bit raspy. I really want to thank everyone for participating here today. I really want to thank Symbiotics for organizing this. We're talking about mobilizing private investment to Africa. This is an incredibly important topic. And one thing we should always remember, we've got 10 to 15 years, a really deep experience of deploying blended finance solutions in order to mobilize private investment to Africa. So I'll start with that. So Convergence was set up as a not-for-profit organization really dedicated to good practice blended finance, where that finance is mobilizing investment to the 142 low and middle income countries to achieve the Sustainable Development Goals in the Paris Agreement. When one looks at our historical deals database, and we're funded to maintain this, we have around 1,500 blended finance transactions for around $260 billion of investment volume. So we're trying to basically capture what is the entirety of all the blended finance transactions that have unfolded to date. And when one looks at that database, one finds around 166 blended finance transactions that have unfolded in the form of a blended finance fund, where the actual primary area of investment has been Africa. So we have identified around 166 blended finance transactions that are funds where the investment region is Africa. So please keep in mind, lots and lots of robust experience. And I can conclude by saying there is no doubt that blended finance funds have been demonstrated to be the most effective and efficient, best way to be combining public and private sector money to mobilize private investment to Africa. So let me start with the big picture. If one looks just at the domestic financial assets in Africa, and we look at the most important metric that the World Bank uses, domestic credit as a percentage of GDP, one finds very low numbers in Africa. We have a very low level of domestic financial intermediation in Africa, and we have a very low level of domestic financial formulation in Africa in order to invest in the SDGs. So if we want to achieve the Sustainable Development Goals and Paris Agreement in Africa, big picture, we have to be mobilizing cross-border investment from developed markets into Africa at a very, very significant level. And given the low level of depth and breadth of the financial sector, we really need to be focusing as best we can on using those blended finance solutions to strengthen the domestic financial and capital sectors. Next slide, please. Our colleagues at the OECD do the best job of trying to identify what has been the total amount of investment that is being mobilized by the entirety of the development finance community. That is really the 33 rich countries that are known as the OECD Development Assistance Committee countries, Germany, France, and others, plus all the multilateral development banks and DFIs. And when we look at the entirety of that information, and we look at the three metrics that are reported by total private mobilization, private direct mobilization, and private indirect mobilization. Private direct mobilization is the key metric that we're looking at. And in total, all development finance has been mobilizing around 5 billion of private investment to Africa. And these have been the main multilateral development banks and DFIs. If you can see here, IFC has been responsible for around 40% of the investment on a typical year, as an example. So we know who has been doing the mobilizing and amongst the MDBs and DFIs. And as I said before, the most prominent approach has been using funds. Next slide, please. Now that slide I was showing you is multilateral development banks and DFIs using their own capital. We at Convergence, we're much more interested on how the donor community is deploying its own funding in the form of catalytic and concessional funding. When you look at Convergence's data, there needs to coexist two forms of funding: catalytic and concessional funds from the public sector, the private and the philanthropic sector that combines with private investment to mobilize private investment. When we look at that subsector, Africa is the key region. In general, most of the donors in the global north, in particular in Europe, are very, very interested in mobilizing private investment to Africa, with lots and lots of examples here. Next slide, please. And when one looks at the actual use of concessional money to mobilize private investment, we look across these three different time horizons, we can generally see once again that Sub-Saharan Africa on the right-hand side and Latin America, generally speaking, tend to be the primary areas in the developing countries where private investment is being mobilized. And once again, funds are the typical tool. Next slide, please. Now, if we're looking at Africa as a whole, there are 142 developing countries out there, 54 in Africa. And this is probably the biggest challenge that we face when we're looking to mobilize or attract private investment to Africa. Of the 54 countries, only 2 of them are investment grade. Indeed, only 5 are rated BB. So we have 49 of the 54 countries, or 91%, are rated B or lower. Therefore, if we wanting to mobilize private investment, catalyze private investment to Africa, the reality is most investors will look at the country risk, credit risk, and when we add currency risk on top of this, and they see a level of risk that is generally too high relative to the fiduciary and regulatory obligations. And that's why blended finance funds, in particular mobilizing private investment in the senior tranche of the funds, which can be investment grade or strong double B, have proven to be the most effective and efficient blended finance solution to create a risk return profile that meets the fiduciary and regulatory obligations, really helping us overcome the underlying country risk by giving diversification to investors across multiple countries and borrowers, and then stratification of capital within a blended finance fund. Next slide, please. Now, if one turns back the clock to June and July of this summer, there was an incredibly important event that actually has unfolded for the development community. The development community met in Sevilla, and for the very first time, developed countries and developing countries agreed that private investment mobilization through blended finance needs to be a significant part of the development and development finance agenda over the next decade. In all reality, developed and developing countries had not agreed this. So the last decade has been much more oriented around experimentation, but strategically moving forward. Developed and developing countries have fundamentally agreed that blended finance needs to be a much more significant part of the agenda, including standardizing those solutions which have demonstrated to be the most effective and efficient. And I'll walk through that in a moment. But here's some of the key content of this outcome document. So this outcome document is negotiated over the course of 7 months by developed and developing countries, and really for all of us in the blended finance and mobilization world, it really serves as the global North Star, with blended finance at the forefront of the agenda of development and development finance. Next slide, please. We're going to take ourselves Convergence. We're working with the OECD, the UN Economic Commission for Africa, and the 54 African countries to really translate that high-level language in the outcome document into a very, very tangible action plan. So over the course of 2025 and 2026, we're going to be working very closely with African countries and African organizations to really identify a fit-for-purpose private investment mobilization action plan to achieve the outcome, to achieve the mobilization objectives of that outcome document. And we envision that this action plan will actually have 4 key components. One of these key components is standardized and simplified private investment mobilization models, which I'll talk about in a moment. Next slide, please. We have spent at Convergence a lot of data, a lot of time, a lot of energy over the last 5 years, especially over the last year, on a project funded by the Gates Foundation, Finland, France, Luxembourg, and Switzerland. We've collaborated very, very broadly, really under this auspice of which blended finance solutions should we be standardizing. We've looked at all of the data, including in our historical deal database and all the data coming out of the multilateral development banks and DFIs. All investors say the same thing to all of us in the blended finance world that's really stratified in the different columns here. Private investors say we can only be investing in viable projects. Therefore, which are the blended finance solutions or private investment mobilization models to increase the universe or number of viable projects? Now, sadly, as in the case of Africa, many of these viable projects will be sitting in countries which have high perceived country risk and credit risk. Therefore, what solutions can happen at an individual project level to increase the investability of projects? We've been able to collectively identify 6 individual blended finance solutions or private investment mobilization models that would allow us to increase the investability of a project. So, for example, PIM number 5 here, guarantee, is the most simple form of increasing the investability of a project. But most of the funding we're trying to mobilize is sitting in the global north, and it's not going to be in Kenya or Rwanda or Tanzania looking to make a direct $15 or $20 million investment. All those investors have said they want portfolio level solutions or funds, blended finance solutions. And we've identified that 3 of the 12 solutions could be blended finance funds. And that's how blended finance funds fit within the whole context here. So 3 of the 12 ideal solutions for a whole strategy of mobilizing would result in an effective way. And the last solution on the right-hand side is FX risk mitigation. So the 12th model is FX risk mitigation. So when one reflects back on the totality of us trying to basically increase the universe of viable projects, increasing the investability of projects, increasing the investability of portfolios or funds, and dealing with FX risk, at the core of this are three blended finance solutions, which are blended finance funds, but they're all part of a bigger strategy of 12 solutions, which would allow us to mobilize domestic capital and cross-border capital to achieve the SDGs in these countries. Next slide, please. And I'll just give you an example of a blended finance debt structure in engaging with this broad community over the last 15 months or so. There's a strong consensus that ideally we would have a three-tier blended finance fund. Most blended finance funds up until now have been two tiers of capital. REGMIFA is going to describe its capital structure. But ultimately, if we want to be mobilizing private investment in the form of senior debt from global north investors, one of the most effective and efficient ways to do this is to create these blended finance funds with the top tier of capital is protected through three aspects. Number one is a top tier fund manager like Symbiotics, who knows the developing markets quite well. Number two is diversification across borrowers and countries and indeed currencies. And then third, stratification of a capital structure where the lower tiers take on defaults and losses if they do occur. And there's no doubt we have 188 of them in Africa. They've all been structured a little bit differently, but each of them have actually produced a senior tier of capital, which has been quite an attractive risk-return asset for investors in a senior position. Next slide, please. So I'm going to wrap up here, given my rasping voice, and really to summarize, we have lots and lots of data out there. We are fortunate in Convergence to have this data. If you're interested, reach out to us. And there's no doubt, if we are trying to mobilize private investment for Africa, blended finance funds have been proven to be the most effective and efficient solution. We're really proud to be speaking here today. And we're going to be working very closely over the next year and a half with the 54 African countries and the UN Economic Commission for Africa, so we can really get a higher level of understanding from the African countries themselves, because they want to be much more involved in blended finance. And really, when we go back to the Sevilla outcome document, please keep in mind, if we want to be mobilizing, we need to be mobilizing at standardized solutions, including these fund structures themselves. With that, I'll wrap up, Laure, before I lose my voice and pass it back to you. Laure?
Thank you so much, Chris. Especially, I know how difficult it can be to speak when you have such a coarse voice. So thanks for, despite your COVID, joining us today. If there are any urgent questions on topics that need more for clarification, feel free to put them in the Q&A. Otherwise, we have reserved ample time after all three speakers for Q&A with the audience. So I don't see any technical question popping up. So Chris, thank you very much for setting the scene and reminding us actually what blended finance can be useful for, and also how incredibly important it is to mobilize all this capital if we ever want to have a chance to achieve the SDGs. Public money only or catalytic capital only will just not be sufficient. So we need to mobilize that private capital. So I'm now going to pass the word to Edwin, who is going to explain to us why FMO, so the Dutch DFI, invest in blended finance funds. And I think it's really interesting to see from actually the more medium layer to understand what it is that you are seeking with these types of structures. Edwin, thank you.
Thank you, Laure, for the introduction, and thank you, Chris, for explaining the concept of blended finance and why it is so important and impactful, especially towards directing funds to Africa. So I've been asked to talk about why FMO invests in blended finance funds. Could you please go to the next slide? Yes, one more. And one more, please. Yes. So I'd like to answer really already the question just by explaining what FMO really is. Like Laure said, it's FMO, the Dutch Entrepreneurial Development Bank. We are a DFI, a development finance institution, but we're also a regulated bank in the Netherlands. Founded in 1970, we now have a balance sheet above 15 billion euros. But if you look at our shareholders, we're 51% owned by the Dutch state, the remainder by Dutch banks and other private investors. And we raise money with the AAA rating quite cheaply on the capital markets to take higher risks and to invest in markets in Africa that, as you heard from Chris, the private investors see as too risky. So what does that really sound like? In a way, that is a blended finance structure. Without the guarantee from the Dutch government on our capital market instruments, we would not be able to raise funds so effectively and take the risks and search for the impact that we're investing in the way that we're doing now. So without that government support, we would not be able to do what we're doing at all. So I think as a first answer, why do we invest in blended finance structures like REGMIFA? Is because it works. We are an example of how it can work and how it can scale. Could you go to the next slide, please? So here you see we have a portfolio above 15 million euros across emerging and frontier markets. And interesting for you is that a third of that is in Africa. So Africa is really a key market where we try to invest our capital. We have 2 local offices in Africa, one in Costa Rica, but most of us all are in The Hague. Next slide, please. So I won't spend much time on this. Like other DFIs, we invest our activities to contribute to the Sustainable Development Goals. We have identified 3 key SDGs. One is SDG 8, job creation. The SDG 10, reducing inequalities, and SDG 13, climate action. We have an ambition to grow the portfolio quite significantly. So by 2030, we aim to have 10 billion invested in reducing inequalities and 10 billion in climate action. Yes, next slide, please. We have focused our activities in 3 distinct sectors. So myself, I sit in the financial institutions department, which means that we invest primarily term funding to banks, MFIs, NBFIs, and some fintech in our markets. We also have a separate energy team and a team investing in agribusiness, food, and forestry. We also have a private equity team, which invests in these 3 sectors, and they represent a fourth, so 25% of our balance sheet. Next slide, please. So to summarize the first section, we invest in blended finance structures because we are a blended finance model in a way ourselves, and it is a proven model to really maximize capital flows towards emerging and frontier markets. But secondly, also within FMO, we have blended finance tools to invest in our markets. So we can really allocate the appropriate source of capital to the investment at hand. We have public funds under our management, but we also have private funds under our management. And on this slide, you see our progression model. FMO, we try to engage in long-term relationships with our clients to support them from an initial high-risk phase to the point where we become obsolete and the commercial investors can take over. So in the middle, the largest cog in this progression model, you see our own balance sheet. So that's FMO's risk appetite. However, as Chris also showed, in some markets, there can be very impactful transactions, which are also outside FMO's risk appetite. So for those investments, we can use public funding. And on the other side, when the risk is quite good, we try to mobilize as much as we can commercial investors, either through syndications or to some of the private funds under our management. So also within FMO, we really use blended finance to maximize the capital flows to these markets. Next slide, please. So here you see 3 public funds that we manage, which we manage on behalf of the Dutch government. One is really on access to energy. One Massive we use a lot for financial inclusion in higher risk markets or very small financial intermediaries. And the other one, Building Prospects, is more on the agribusiness side. So really alongside our 3 focus sectors. Next slide, please. We also manage a fund on climate adaptation and mitigation. We also have 2 programs with the European Commission together with the Dutch government. And interestingly enough, also the UK government has entrusted us with a fund to manage on their behalf, which is on mobilizing finance for forestry. So it's not only the Dutch government, also the UK government relies on FMO's due diligence and investment process to invest in high impact transactions in emerging markets. Next slide, please. So as I mentioned, when we see that the risk is good enough, or when we think actually this is a project that also commercial investors could invest in, we will try to source in private investors either through syndications or through these mobilization programs here. We have 5 different funds under our management. The biggest one, the largest one, is the SDG Loan Fund, which is about €1 billion in size. And this is really a great tool to increase the volume for our clients, but also to get private investors familiar with investments and familiar with certain markets. And they really rely on FMO's investment process to get comfortable with the risks identified in these markets. And next slide, please. Yeah, could you go one back before I give all the answers of why we invest in REGMIFA? Thanks. So summarizing, FMO in a way is blended finance. We use blended finance a lot. So why do we invest in blended finance debt funds? Well, because we're familiar with it. We know it works. However, you could think, why do we invest in other funds if we have all the tools at our disposal ourselves to do it? Well, I think the first answer was also given by Chris. There is a huge financing gap, so we definitely cannot do it ourselves. Also, the public funds that we manage for the higher risk transactions are really scarce. So we need to collaborate with other parties. And secondly, while we do have these tools, our investment process can be quite lengthy. It can take us easily up to 6 months to do a transaction, especially if there are higher risks involved. Because of this and our operational costs that we have, we really need to look at larger transactions, so above 10, 15 million. Maybe with public funding, we can go a bit lower, but really we can't do too many of those because they just take us too much time and we need to also cover the cost of our staff, etc. So through a fund like REGMIFA, we really can have great impact outreach with one investment through 50 investees. Can you go to the next slide, please? So it's really about an impact story. And if you look at the things that REGMIFA is doing, they have 50 investees in 22 countries. Half of them have a total assets of less than $50 million, which are not companies we can finance directly. I mean, we would love to do them, but we simply cannot do it. Also, the average exposure is about 3 to 4 million. We have tickets of at least above 10, 15 million. So in this way, REGMIFA is really complementary to what we are doing. Also, if you look at the countries they are active in, they have 41% of the exposure is in least developing countries. This is a key strategy of FMO. but it's also difficult. It can take a long time to do the transaction. Halfway through the transaction, something may change. There could be a change in the political situation. The macroeconomics may change. There might be a natural disaster. There's a lot that can go wrong in a time frame. So it's really impressive that the REGMIFA is able to do so much in these markets. Yeah, I can name a few more. They have technical assistance. They're doing local currency loans. And also importantly, because of our investment in this mezzanine capital layer, we are also catalyzing other private investors in the more senior tranches. So it's not only the impact indirectly towards the end investees, but also really getting more private sector capital into these markets. So the impact is really strong, but the risk is also quite good for us. As Chris identified, there is also a most junior first loss staking layer. REGMIFA has it as well, and I think it will be shown in the next presentation as well. There's a 33% requirement of C share to total assets of the fund. That's a good protection for an investor like FMO. So also in the capital structure, we're quite well protected. And the assets in the fund itself, we also rely on Symbiotics as an experienced fund manager with a good track record in these markets. And also very important that their standards in terms of ESG, environmental and social risk management, corporate governance, and because it's a lot in microfinance, also client protection principles, those are really key for FMO to know that through our investment, we are not harming environment, people, but we're actually doing something good. So we can also rely on those practices of the fund manager in how they manage the assets in the fund. So I think that's maybe a good example of why we like investing in a fund like REGMIFA. It's really complementary to what we are doing ourselves, and it's really an extra layer of being able to finance a very impactful earlier stage of financial intermediaries that we're not able to do ourselves. Could you go to the next slide, please? Yeah, so in more generic terms, I think this kind of summarizes what we are looking at when we look at the debt fund opportunity. It's really about a balance of impact, risk, and return, which it really is with all of our transactions. So it's not specific to funds, but more so in funds, we really look at impact and additionality. So it has to do something that we're not doing ourselves or we cannot do, or that we find difficult to do, which is the example of LDCs, maybe fintech companies, which are different business models, we also find more difficult to do ourselves. So we really look to partner with those funds which are really additional to our own offering, or maybe they provide a learning opportunity for us. So it's really about the impact story. And on the risk return, typically we look at funds which have a decent size, so they also have enough diversification. Really, it should be above a $50 million in portfolio. Should be investing in countries that we're investing in, so it shouldn't have too many exposure should not have exposure in Europe or North America, for example. And we like to work with experienced fund managers who are in line with our impact strategy and also risk management in terms of reputational risks. Also important is that a fund should have acceptable remuneration metrics. It should be about the impact, and it should not be about financing the salaries of the fund managers. When we're creating an extra layer between us and the investees, it really should be about acceptable returns to the fund managers and the benefits of the blended finance really flowing to the emerging markets and not to the fund managers in Europe or elsewhere. I think we can go to the next slide where we have a few examples of some of the debt funds in our portfolio. I've tried to focus mostly on the debt funds that we have in Africa, most of it which are within the financial institutions department and the energy department. You see REGMIFA, we also have the medical credit fund who invest in healthcare SMEs in Africa. The ALCB fund, they invest in African local currency bonds, so really deepening capital markets in the continent. Lendable is a global fund, but they really invest in that fintech space that I was explaining. So companies that are not yet accessing bank financing, but do have like a funding need and are really innovative. We also have several funds we have one in Latin America, for example, which provides local currency funding to microfinance institutions. It's really a diverse combination of funds, but all really doing something additional to what we are doing and being really impactful. So I think wrapping up, I hope it's clear why FMO invests in blended finance funds. It's really an excellent tool to maximize capital flows towards emerging markets and frontier markets, especially crowding in private sector money, which is so needed for these markets. So hopefully there will be more emphasis on this and more potential projects where also FMO can take a role, ideally in like the mezzanine space, to crowding in more private sector investors. Thanks.
Thank you very much, Edwin. And thanks for underlying as well that blended finance actually is everywhere already. And my organization, the NAB, published a report a couple of months ago, and we actually concluded that, and it's a bit like impact investing, a container term, but that has many different meanings. And when you also mentioned the progression model of FMO and also the capital structure, I think it's interesting to see that FMO itself and probably many other DFIs are actually blended finance vehicles. So it is way more present than what many people think. And I think we should be more outspoken about all these models to be able to show that blended finance is not that very exotic thing, but really something that is happening, and also very impressive to see in how many other blended finance funds FMO invests. So thank you for that. We are moving on to the third and last speaker. Luz, you're going to talk about how REGMIFA is basically fostering innovation in Africa. Maybe let me say a couple of words of introduction. I've had the privilege of being part of the supervisory board of REGMIFA since 2019 and chair since 2020. And I am incredibly impressed by how efficient REGMIFA has been opening markets. It started with the idea of making financial inclusion in Sub-Saharan Africa accessible to private sources of capital by bringing catalytic public capital. And it's still opening more and more markets, frontier markets in the region. So I think this is for me the most impressive characteristic of a blended finance fund like REGMIFA, but I'm not going to steal your thunder, and I will let you start on the presentation. Luz, the floor is yours.
Thank you so much, Laure, and also thank you, Edwin and Chris, for your presentations. That all you mentioned different elements that set the stage perfectly for this transition and to introduce REGMIFA and go more in depth on that type of blended structure that it is and what little elements work in favor to really mobilize capital and make an impact. So if we can move to the next slide, I will take just a few seconds. No, before, perfect, thank you. Just to say something about Symbiotics, who's been the asset management, the investment manager of REGMIFA since REGMIFA was launched back in 2010. And Symbiotics is an impact investor that's been present for more than 20 years and currently has about a bit short of $3 billion of assets, $1 million of assets under management. So let me tell you a little bit of REGMIFA. So as I said, this is a blended finance structure that has been present for more than 15 years. In the left-hand side, you can take a look at this current capital structure that is as of the end of the third quarter of this year. You see that we have different layers that Chris introduced already, and it's also pulling funding from different public institutions and also mobilizing private capital from, you'll see that private investors, that is a mix of ethical banks, congregations, and impact funds. And then in the middle, I'll touch a little bit on the characteristics of REGMIFA. Edwin mentioned a couple of them, but basically it is quite diversified in terms of countries, but also in terms of investees, with close to 60 investees currently in the portfolio. The total assets of the fund is at around 200 million. Besides the US dollar investments, there are other 13 currencies that are in the portfolio. And this is very important for us because since inception, it was always envisioned that there was going to be a big effort in lending as much as possible in local currency and having a strong portfolio in local currency, because the fund was in a better position to manage currency risk rather than the investees of the fund. And you will see on the top right bottom of the presentation that the top 5 currencies, of course, still for about 40% of the loans are denominated in US dollars, but still 13 currencies besides, and CFA francs are being as part of those top currencies, show that we are, reaching that objective. Let me tell you a little bit more about the impact of the fund, because I think that's quite important to mention. Blended finance is not only about mobilizing capital, but also about having this impact. REGMIFA is an Article 9 fund that has a social investment objective and targets 3 core SDGs. Number 1, no poverty. Number 5, gender equality. And number 8, decent work and economic growth. And since it was first set up and launched, the mission was aimed to be to foster economic development in the region and to work and finance financial intermediaries that were serving MSMEs and also low and middle income households. And as Edwin mentioned, REGMIFA has way smaller ticket or average ticket sizes. So the average disbursement per investee is about 1.8 million, and the average exposure per investee is short of 3 million. So that does show that we do smaller tickets and we diversify as much as possible in the region and in terms of investees. You can also look from this slide the top 5 countries by exposure in the portfolio. It's not surprisingly, Kenya, Nigeria, and South Africa taking the first three spots. Sorry. And just to wrap up and going a little back into the impact, REGMIFA does target and does measure what is the impact, over the years. And right now we have some targets in trying to reach over 200,000 end borrowers per year, that at least 50% of these end borrowers are women, and that at least 1/4 of these end borrowers are based in rural areas in the region. So we keep track of these indicators, we make sure that we understand the dynamics and that we keep on improving and progressing as time goes by. So if we can move to the next slide, please. Thank you very much. In this slide, I'll just give you, we talk about this blended finance fund that was launched back in 2010, but I want to give you a little more of the history. So it is an open-ended structure in which the junior shares, and I'll show the capital structure a bit more in detail in the next slide, but in which the junior shares take the first losses, and there's also an income waterfall. But another particularity of these C shares or junior shares is that they do not have a maturity. It's unlimited, so that makes it possible to have this open-ended fund. And then whenever the income that is, after all the income generated of the fund and we paid all the expenses and the interest on notes, there is a particular income waterfall in which the target dividends of A shares or senior shares is distributed, then the mezzanine shares or B shares, and then finally it's distributed to the C shares or junior shares. And besides taking the first loss and being concessional, they also capitalize any dividends that are paid to them. And that makes it possible to kind of replenished these C shares and to make the fund open-ended and to really reach its mission. Another particularity was when this fund was launched. I already explained the mission, but it was targeting to serve MSMEs through financial intermediaries. We know how the dynamics in the region have changed, especially in the past 15 years. And back in 2020, it was decided to adjust a bit this mission and also support access, the access to finance for low and middle income households, but also the provision of basic goods and services. And given that it is the junior, well, the shares in general, but mainly the junior shares, the shares that take any default risk, then whenever there is a decision in terms of changing the investment objective or changing, adapting any strategy to invest, all the shareholders have to be consulted, and there's an approval that needs to be granted for this to become a reality. Edwin also touched on the technical assistance facility that accompanies the fund. This was set up since the beginning, and the idea was that it was going to be funded from two main sources: donor contributions that could come from the shareholders of the fund themselves, but also whenever the income waterfall that I mentioned at first, the more senior shares are paid before the junior shares. If there's any leftover income to be distributed, part of it can be allocated to the technical assistance. And this facility is supporting our investees to improve their process, their governance practices, to develop ESG risk management systems, to start launching gender equality practices, etc. So this technical assistance facility is very important for us and for the fund to really continue making a large impact. And this also has to do with the additionality that the fund provides to investees and also in the region. And finally, we cannot leave the FX risk management and FX currency behind, because this was an element that since the inception of the fund was thought of, because it was quite evident that if you wanted to provide local currency as much as possible in the region, it was going to be probably necessary to take some open currency exposure. So two things have been working positively for REGMIFA in this area. First, a partnership with another blended finance / hedge fund that some of you might be familiar with, so TCX, based in Amsterdam, that provides liquidity for hedges in currencies and in tenors in which commercial alternatives just don't have that possibility. But also, Symbiotics itself has developed some expertise in the years that we have working in emerging markets, and we have also customized a strategy for the fund to manage the risk and keeping them under control, because we understand that that could be a bit of the control given the volatility of the regions. And I think we can move on to the next slide, and we're going to take a look at the capital structure of REGMIFA. It was, when this fund was conceived, it was clear there were a bunch of risk factors that would make it difficult to attract private investors. I think Chris made it very clear, the risk in countries, in the Sub-Saharan African countries, having only 2 that are actually rated as investment grade and the rest even below B. Then the possible eligible counterparties have a profile that was very unique in terms of many of them could be not regulated institutions, some of them could be at a nascent stage, some of them were not being profitable. So this profile, obviously, I think if any private investor would look at high-risk countries and counterparties, they would just run away. And there, of course, we were piling up some potential FX risks that could have to be taken by the fund, and this on top of the usual risks that a fund is exposed to, such as liquidity, asset and liability management, etc. So that's why this capital structure was envisioned. In the dark blue, you'll see that the junior share tranche, or C shares, have to always represent 33% of the total asset value of the fund. Then the mezzanine shares, so this has 4 or maybe 5, we can call it even 5-layer structure. So 3 for the shares and 2 for the debt. Then we have this mezzanine B share part, and the B and the C shares have always to represent 50% of the value of the fund. And when this, if this were to fall below, no more notes can be subscribed, no more A shares, but of course there could be subscription of C and B shares to kind of go back into compliance. And then there is the A share class for those DFIs or public investors that maybe can't take first losses or cannot be in the mezzanine part, and add another layer of protection for the private investors. And then we have the subordinated notes that is also kind of reserved for those public institutions that really can't go into equity, but they can help us a little bit and give another layer of protection for those private investors that are sit senior to all the public institutions. And I think it's important to mention here that German rating agency recently rated the notes of REGMIFA, assigning an A rating. So for us, we feel proud, and it has to do obviously with this very strong capital structure in which the first losses are taken by the C shares, and then the risk ratio of B plus C shares is at 50%. But it also has to do with the diversification in the portfolio, the good performance and track record that it has, the low write-off ratio that the fund has. Just to mention, it is at 1 or right below 1%. So, and then also the fact that the C shares tend to be replenished when they get the dividends, that also helps to just have this good rating for the notes of the fund. So let's move on to the next slide, please. Okay, so this is in practice how the capital structure looks throughout the life of the fund. You'll see that at the beginning, of course, it was mainly made up of A, B, and C shares. And as the fund has been growing, then we see the orange part, which is the notes kind of growing. And obviously, given that the C shares can only represent 33% or more of the fund, there is a natural cap of the fund as long as we don't have additional subscription of C shares. I want to highlight from this slide a couple of things. First of all, that you'll see that from 2015 to 2018, there was a downward trend of these C shares. So what happened there? Since all of the C shares are unlimited, this had to do with the losses that the fund was recognizing and were assigned to the C shares. So there was a loss, and that was taking a hit that was taken by the C shares. But after that, you see that the trend changed between 2019 and 2020, and that had to do with an additional subscription of C shares plus change in the trend. Since then, the result and the outcomes of the fund have been improving and reaching up to 2025, when we expect that the C shares will be very close to nominal value. So we're very proud of this achievement because, of course, that helps to see that the financial sustainability of the fund will continue, and we will continue to grow the fund. We have right now capacity to grow to levels of 240 million or even a bit above that, given the amount of B shares and C shares that the fund has. And I think one little element that, no, wait, I did mention how it has been replenished, the C shares. So I think we can move on to the next slide, in which I'll be talking a little bit about the additionality of the fund. So as mentioned at the beginning, REGMIFA targets underserved segments. It's trying to work with a wide range of institutions that go from very small institutions in terms of size that help them providing funding that is stable and with better conditions that maybe they could obtain. And the better conditions can be in terms of tenor. It can be in terms of the currency that is denominated in local currency and not in hard currency, but also has to do with not asking for guarantee. So it's unsecured senior debt. That's the usual product that is provided by REGMIFA. But in other cases, when investees are growing, or when we identified a very impactful institution, financial intermediary, we can also partner with them if we feel that we're gonna help them diversify their funding sources, or maybe also when they partner with REGMIFA and they can take advantage of the technical assistance facility and improve some of their practices that they don't have to be necessarily their internal process and control system, but it can be something a bit more related to the development or ESG risk management system, or as I mentioned, maybe a project to develop gender products to to target women, for example. And finally, this is all used to really build a resilient ecosystem in the region and to eventually see if the local funding conditions improve and just reactivate. And I want to close this slide by telling you a little bit the story of the graph that you see on the left-hand side. So the pink bars show what is the size of the investees of REGMIFA as of 2024. So that was the portfolio of our investees. So 3 were classified as tier 3, meaning they had the total assets of 10 million or below. Then 20 had a size of 10 million to 50 million, and high tier 2 is between 50 and 100 million, and tier 1 is above 100 million US dollars of total assets. And the green bars show what was the size of the same institutions, but when REGMIFA first invested in them. That could have happened back in 2010 when the fund was just launched. It could be one of the first investees, or it could have happened later down the road, let's say 2018 or 2020. But basically, what we're trying to say here is for 11 of the institutions that we had in the portfolio in 2024, when we first invested in them, they were quite small. And actually 5 of these institutions had not reached break-even. However, for institutions, REGMIFA was one of the first international lenders or one of the first 2 lenders that they were getting funding from. And those 11, 3 remain at this small size, but 8 move, 7 to the tier 2 category, so between 10 and 100 million, and 1 actually grew all the way to 100 million. And you may wonder, why are you still engaged, when they grow up to that level? Well, REGMIFA still provides a good alternative for diversifying their funding. It's a stable partner that they can come to, and also it helps them with the TA and the very diverse TA programs that we offer. They can leverage and just build more capacity internally. So for me, it's great to see that we have now quite a well-diversified portfolio. We don't forget the smaller ones, in which our additionality is more important, because we might be the first international lender. We might be the lender that's providing these longer tenor loans without guarantee. But as they grow, we still play an important role, and we need to make sure that that's what we're doing with our investees. So I think we can just go to the last slide, and I'll be wrapping up, I think more or less according to the expected time. So I think I just highlighted a few positives while going through the presentation, but I want to just summarize them right now. Obviously, there's an important impact of the fund, where it targets certain SDGs, and we want to keep track and monitor the progress. We always want to make sure that our investees, that we are providing that sense of additionality, but it works in both ways. We also need to make sure that they have good crime protection practices, that they are using the funding in a responsible way, and that they are actually true to the mission that they're following. I think it's clear how the fund has achieved the private capital mobilization. It's good that, given the performance and the capital structure, the notes are perceived as quite strong credit risk of A, and the track record shows that the fund is performing well. But I also think that we have to give some credit to the investees that are part of the portfolio, because they're quite resilient, even in times of COVID, for example, or during the 2014 and 2016 crisis in which there was some transferability problems in the region. On the challenge, what is the challenges that we keep on facing is that while we've been able to diversify the funding from note holders, it's not always an easy discussion, and we still feel that the high risk perception remains there, and it's difficult to convince them that the risk adjusted return of the fund is quite good. And for us, already when the notes of the fund obtained this A rating, it kind of confirm what we already knew, but it's not always easy to just continue mobilizing this private capital. And as I mentioned before, right now we are kind of limited by the amount of seizures, which are very precious and valuable because they're do represent concessional funding and very catalytic for the fund. So that on top of the prevalent risk that the region faces that makes it challenging from both sides, from portfolio growth sides, but also from attracting more capital side. So I think I spoke quite a lot already, so I'll pass back the stage to you, Laure.
Thank you very much, Luz. And we already have a few questions in the chat. So this is an invitation to the audience. If you have questions for some of the speakers, please do not hesitate to put them by clicking on the button on the top of your screen called Q&A. And I'm going to kick off actually with a first question, which is a sort of more broad context question directed to Chris. Of course, Luz and Edwin, if you have additional mentions afterwards, do not hesitate. But the first question, and it links a little bit to what Edwin was saying, that catalytic capital is really scarce. So the first question for you, Chris, was following on the Sevilla initiative. Are there already firm commitments from OECD countries in place to provide first loss/junior capital to blended finance funds? Have you heard anything?
Yeah, it's a great question. I think all of us in the blended finance and the development finance world really understand that the most important ingredient is this catalytic and concessional capital that goes beyond the mandate of FMO's balance sheet or IFC's balance sheet. FMO, as we just witnessed, does some excellent work. And really, the biggest pool of that funding is what the rich world calls official development assistance. So these 33 members of the OECD Development Assistance Committee, they allocate around $220 billion of official development assistance every year. That included the US money. Okay, US was around 65 billion, so that's been reduced by 65 billion or thereabouts. Now that's the most important pool of funding because that money can take on risks that the MDBs and DFIs cannot take on. It can take on risks that's equivalent of double C or single C, as an example. It can take on a return that's well below market. But Laure, in general, to date, most of that concessional and catalytic money in a typical year, around 75% of it that comes into blended finance is given to the MDBs and DFIs to go do good development impact and climate impact with very low levels of mobilization. So unfortunately, most of the money is gifted by them to the MDBs and DFIs, either directly or indirectly through the European Commission facilities or the Green Climate Fund and so on. So there's very low amounts of aid available to the market. Now, yes, the donors are kind of currently doing two things to rectify that. The Danes are leading something called the Investment Mobilization Collaboration Alliance. You can go look that up on the internet. The Investment Mobilization Collaboration Alliance. It's led by the Danes and the Nordics. They're collaborating together to make their funding available pursuant to calls for proposals. And then secondly, our colleagues in Germany are really leading something that's called SCALE, that used to be called the Hamburg Sustainability Platform. And they advise us that in May of next year, they'll kind of have wrapped it up and they'll be in a position to be allocating that money more directly to the market.
Thank you, Chris. So that's indeed one of the issues. Where do you find the capital? And public capital is often not very flexible and requires, and we've heard several times about a 7-pillar assessed organization to be able to receive funding, for example, from the European Commission. Yeah, it makes the DFIs obviously the more obvious candidates. And we see that I think an organization like FMO is using these public funds for their funds like Massif or for the pioneering part. But indeed, there is still a need for the market. So where do we find that money? Is philanthropy maybe, if I can just follow up on this question, Chris, do you see big philanthropic organizations? I'm thinking about MacArthur Foundation, maybe MasterCard.
Yeah.
Do they also provide?
Yeah, great question. So the catalytic, there's something called the Catalytic Capital Consortium, okay, which are a group of philanthropies. As you mentioned, MacArthur, Rockefeller, and Omidyar came together, and they've been pooling their money, making it directly available to the market versus the MDBs and DFIs, okay? And yes, there's even beginning to be more collaboration between the philanthropics and the publics, because ultimately, you're identifying the most important ingredient. If we could get whatever's available made available to the best ideas, whether they come from the MDBs or whether they come from Symbiotics, they should be supporting the most effective and efficient ways to mobilize private investment. And in general, around 80% or 75% of that money is gifted to the MDBs and DFIs, not subject to competition, not subject to the best ideas. And if we could get there and they could collaborate, this is one of the key ingredients. I mentioned 4 key components of an action plan. One of them is a network of catalytic and concessional funders collaborating and making it available to on a competitive basis to the best ideas.
Thank you very much, Chris, for this additional information. Really useful, and I think that I believe there are a few blended finance funds also on our webinar today, so I think useful information for them as well. So maybe a question for FMO. Actually, 2 questions for you, Edwin. First one is, what kind of returns do you normally expect from blended finance funds? And another one is, are you planning to diversify from the sectors that you presented?
Thanks. Thanks for that question, Laure. You can hear me, right? Yes. Okay. So I think on the first question, I already showed it a bit in my presentation. It is really a reflection on one, impact, and then also risk return. Typically, what we see in our debt fund investment is even though that it is in the capital layer, so we are, for example, in the mezzanine layer in REGMIFA, that it is really structured as a loan type of instrument. So it has a repayment schedule, it has a maturity, and typically we look at returns that are in between SOFR plus 1.5 to SOFR plus 3%, around that area, but it really depends on the capital structure. If there is a very strong protection, a very strong public funding first loss tranche, then our return can also be a bit lower. However, if there is a very, very, very slim first loss layer, then we will be seeking a higher return. It really is a reflection on not only the capital structure, but also the risks of the portfolio that is invested in, the experience of the fund manager, and there are other areas that we would rate a fund on to get to an appropriate pricing to such an investment. I will go to the second question. There we do have a strict sector strategy. So it's energy, food, agri-forestry, and financial institutions. So that really means that we're looking to invest in those areas because we believe that those are the key sectors for economic and social progress in these markets. However, when you look at the financial institutions sector, our bread and butter is really providing term funding to banks, right? To banks, MBFIs, MFIs. They do the on-lending to projects, companies that are in line with our impact strategy. So REGMIFA is just like that, right? It's a financial intermediary. Well, REGMIFA is also investing in financial intermediaries. But you could imagine that if there is a fund which is doing something very impactful and additional on a different sector, then we still rely on the fund's underwriting criteria and how they manage their assets and how they're realizing that impact. But it could then be in a different sector. For example, when talking about the medical credit fund, they're investing in healthcare SMEs. That's not our sector, that's not our experience or expertise. However, if we feel comfortable with the fund manager and the fund that they have that expertise and that knowledge, then we can rely on that for on-lending to that segment. So from our perspective, it does have a strict three sector focus, and we're not planning to deviate from that as far as I'm aware. But through financial intermediaries, there are other impactful sectors that could be targeted.
Thank you, Edwin. Very clear. Maybe let's move on to a question for Luz. Interesting about the structure of the fund. So what are the biggest challenges for the REGMIFA fund to A, maintain its capital structure, and B, maintain a healthy investment portfolio? Can you tell us a little bit more? So capital structure and quality of the portfolio.
Okay. So this is a bit of a balancing act. We want to have the money and deploy it, but at the same time, make sure that we're not close to reaching the risk ratios. So we've always, we have to have a very, hands-on risk management in terms of the liquidities, in terms of all of the breaches that we could reach and we could have. Just to and if we have a year in which we feel that our investees are not performing very well and the provisions is increasing, then we need to see, okay, is there a time to invest a bit more on notes, or should we take a bit of a cautious approach and focus more on bringing more shareholders now, and we have to be kind of looking forward always 6 to 12 months at least, besides the 3-year forecast that we always do, to ensure that if we're going to be growing the portfolio, we have the best case scenario, but we also have the worst case scenario, and see how much we can grow it while we maintain the needed ratios that we need to not have breaches or put the fund at risk. So it is a bit of a balancing act. It's been quite good because the C-shares right now are at a place in which they're at a quite large amount. It lets us grow about 15 million per year in the next 3 years. But yeah, it's as we get close to that, we need to make sure that we start having the conversations to recapitalize the fund and to continue growing and not put it in danger. In terms of the portfolio, I mean, the planning, you plan something and then the reality hits, and then you try to act and see how to adjust. But yeah, I mean, every year we have to look at how it went, what went wrong and what went right, and what we need to adapt to continue growing or to adjust. If it's in terms of a lot of maturities coming up next year, when we need to set a strategy in terms of what we renew and what new investees we need to increase, and and like what we also look at our impact metrics, how we did, and where we need to focus our efforts. So it's just a balancing act in which you have to review it every 3-6 months and adjust. And also we are always being kind of aware of what's the dynamics in the region, and what we can do with what we have and what's happening.
Thank you very much, Luz. Maybe moving on, talking about risk, moving on to another question for Chris here. We talked a little bit earlier about also, I think, Edwin, you mentioned, and also the regulatory constraint. FMO is a bank, so there are regulatory constraints also for providers, private sector capital. So the following question is for Chris, actually more generally speaking, beyond the MDBs and the DFIs that typically anchor a blended finance structure, do you see as the main barriers preventing pension funds from participating more actively in these transactions? Have you noticed any meaningful shift or momentum in the engagement of pension funds lately?
Yes, the answer is yes. I think all of us should understand there's been huge movement by the private investment community to understand blended finance more. I could cite to you probably 11 or 12 different private investor groups. Okay, for example, the Global Investors for Sustainable Development Alliance, the Net Zero Asset Owner Alliance. In general, most of these are global north pension funds, insurance companies, institutional investors, investment funds. They have an incredibly high interest in investing if the investment can meet their fiduciary and regulatory obligations. I think one of our bigger failings in the blended finance community has been that we have not created the vehicles that they're really interested in. Number one is size. Okay, if we want institutional investors, we really are talking about funds, probably 500 million or more in size. That still continues largely to be a unicorn in the blended finance community. We have lots of $100 million, $200 million funds, but in general, by definition, we're just almost foregoing the institutional investor. If we want the institutional investor, it needs to be up around 500 million. So we collectively haven't responded. That's why Edwin mentioned the SDG loan fund that they did with Allianz is a great example of the size that the institutional investors want. Number two, if they're debt investors, ideally they're looking for formally rated by hopefully Moody's, S&P, and Fitch, and that rating would be investment grade, i.e. BBB or more. Really glad to see Luz said that REGMIFA now has an investment grade rating by a German rating agency. That continues also to be an outlier. On the equity side, it's a little more difficult than debt, because on the debt side, we've been able to demonstrate earning a premium by investing in emerging markets. We haven't done that. But yes, the answer is absolutely. There's around 11 investor groups. If anyone's interested to know who they are, we spend a lot of time with them, and they helped us identify that these 12 models would be the most appropriate if we wanted to be mobilizing the funding into these countries.
Thank you very much, Chris. Maybe a follow-up question, if your voice is still okay. Actually, on mobilizing additional funds. So one of the questions from the audience is that the impression is that mobilization metrics are incredibly overshadowing impact metrics, and the conversation about investees is getting less attention. So how do you view this trend? Do you agree? And how? And if yes, how do you view this trend?
Yeah, I fundamentally disagree with that. Okay. We're at the epicenter of blended finance for the last decade. I can assure you, everyone on this phone call, you should be aware. The Dutch government, the French government, the British government, the Canadian government, in the form of their development agencies or the ministries of foreign affairs, they have rigorous tests to allocate their official development assistance. Okay, if we can't demonstrate strong development impact or climate impact, they simply will not allocate any of that money to blended finance or not to blended finance, right? There's no way we're going to get the Canadian government to come up with a completely different process to allocate their funding for this deal versus that deal. It has to go through a rigorous impact process, okay? I can assure you, I have never met one public or philanthropic entity that doesn't have a very rigorous impact approach. We're completely failing on the other side. It's not impact that we're failing. We're failing on delivering investment at scale, standardizing, and delivering vanilla that investors want. There's, as I said in our database, we have around 1,600 blended finance transactions. Each are unique. The average deal size was 55 million, and it took 2 to 3 years to complete. We're collectively wasting our time doing a bunch of small transactions when we should be standardizing, allowing us to move and mobilize. So, for example, institutional investors, generally speaking, are not involved in blended finance because the deal size is too small. Okay. If blended finance is here to mobilize at scale, we have to increase supply of investment to institutional investors. We have to standardize the structures, and we have to get collaboration amongst donors to get it done. And lastly, I can assure you, nobody is sitting in today in Paris or Berlin or Ottawa saying, my only objective is to mobilize an investor. It's, I have this money I can only allocate for development impact and climate impact. Can I allocate some of it to also mobilize private investment?
Thank you, Chris. Maybe actually I'm going to follow up on this question with a question for Luz. Looking at the maximum 50% of fund capital in notes for REGMIFA, it appears that the fund could raise a lot more funding, up to 75 million in notes, and likely maintain the A rating on the notes. So is that the case? And if not, or if so, why is the amount of notes currently so low? So do explain, how do we scale up?
Yeah, no, that's a great question, actually. I mean, the calculation, of course, just taking the CMB is correct, but if you look at the C shares, it's actually it's a bit less than 75. It should be around 55 million that the fund could grow while before it, breaches the 33% of the C shares. But it's true. So we could, but then the challenge is what I was explaining a little bit before, this balancing act. Of course, we need to grow the portfolio fast, but we have a ticket size of less than 2 million. So it's not that easy to suddenly invest, 100 million. That means an average 50 transactions every year, and do due diligence on each one of the investees, do ESG risk and assessments, sanction ratings, do contracts, etc. Every year, right? To grow the portfolio. So this is what's been happening. So we aim to grow the portfolio right now between 10 to 50 million. That includes a lot of redemptions or renewal of loans. And the objective is that probably in 3 to 4 years, we can reach that 240, 250 size that the fund can have and have that close to 50% of notes that we're aiming to do. So yeah, right now the plan fully for the fund in the next 3 to 4 years is, yes, renewing A and B shares that we have in the portfolio, but any additional would come from notes that we just fundraise. And so far it's been, I think we have a good plan for the next couple of years. But again, it has not been that easy. Sometimes the conversations with private investors is not that easy. And I think you mentioned something very important, Chris, when you said 200 million fund, that the minimum ticket size that pension fund is interested in is 20 to 30 million, and sometimes that's a lot for me to then be able to deploy it, in the next 3 to 6 months. So we're trying to find that, and I do believe that we have a good strategy, and that next time that we see each other, we'll have a higher share of notes there, and we'll be very proud of that.
Thank you, Luz. That's also partly responding to the dilemma that was mentioned to Chris. So why are we not scaling up? Well, it's sometimes there is a mismatch between, the supply of capital that needs big tickets and the demand of capital that is in smaller pieces. And very often blended finance vehicles are on riskier sometimes, or more often than not, smaller projects, because when it's time for them to grow, they're not that risky anymore. Being mindful of the time, so maybe one last question for Edwin, for FMO. Do you currently have facilities that catalyze first-time fund managers in Africa with an interest specifically in the agri-value chain? So I do believe that the agri is covered, but do you have facilities that catalyze first-time fund managers in Africa?
And what is meant with catalyzing first-time fund managers? We work with a fund manager for the first time?
I think that would be putting a higher risk capital, maybe mezzanine capital. It's not in the question, but I'm sort of freely translating. Maybe first loss with your public funds.
So I think, which is something I think what would be great is that we also help develop or work with local fund managers, so that local fund managers start managing these funds. many funds that we're working with, they are also managed by some European-based fund managers with local offices. But in theory, we could also work with locally based fund managers that focus really specifically on a market or a region, having the local presence and the knowledge of that market. So we can work with local fund managers. Ideally, they would have some experience, but yeah, as you saw in our progression model, REGMIFA, for example, is something that we have on our own balance sheet. If we see a fund proposition which is a higher risk, or maybe is with a less experienced fund manager, and we do not feel comfortable taking it on our own balance sheet, then we can also look at our public funding to provide such an investment. And the similar logic applies. We can look at what is an appropriate level of risk for that fund manager and an appropriate risk of rate of return for that fund manager, similar as it would be for us and to our other types of investments that we do. So that is possible, but also within the public funds, there is often then a cap or a maximum exposure that they can do in debt funds. And we have seen in the past years that we saw a few very impactful higher risk debt funds that we were not able to do because we were already at that limit on the public funds. So it is an opportunity, but also a challenge in that regard.
Thank you, Edwin. I hope this answered the question. So we had many more questions in the Q&A. I'm sorry, I've had to select a little bit and I tended to pick the ones that were more related to blended finance. There were many questions also about target sectors and criteria to invest. I'm not too sure. Luz, are we going to do a written follow-up maybe for some of the questions that could not be answered?
I think that's possible to do. So we'll try to do that. Yes, I'll see we have all the technical information to do so.
Okay, so we will endeavor to respond to all the unanswered questions. Rest for me to really thank our three speakers, Chris, Edwin, Luz. Thank you so much for responding to our questions and presenting this interesting conversation. And I hope the audience enjoyed this as much as I did. Thank you and have a nice day.